Hello, today we'll be going over the second part of the video lecture for the chapter on stockholders' equity. In this session, we will be talking about preferred stock and all its features, and then we will be talking about the dividend policies and all the different types of dividends that companies normally give to their stockholders. So let's get started. So we call preferred stock a preferred stock because of several preferences that the stock has over common stockholders when it comes to stuff like getting dividends, receiving assets upon liquidation, so on and so forth. So anytime the company declares and pays a dividend, the preferred stockholders are paid first, and if there's any money left over, then we pay the common stockholders. Also, if a company goes into financial bankruptcy and is liquidated, which means they basically appoint a receiver who will come and sell all the assets of the company piecemeal and pay off all the creditors from the proceeds of that sale first, and then if any money is left over, they pay off the preferred stockholders before the common stockholders are paid. Also, preferred stock sometimes is issued with a feature that is a convertible feature just to make it a little more attractive. So maybe after a few years, at the option of the preferred stockholder, they can convert the preferred stock into common stock, which is an attractive feature because remember, preferred stock they don't have any voting rights. They are simply dividend receiving kind of a stock. It's a security. So maybe these preferred stockholders want to become the real true owners of the company and by getting voting rights. So the conversion feature would be an attractive feature for them. Also, sometimes preferred stock can be callable at the option of the company. What it means is preferred stock is a security which is different from debt, because bonds payable, which is a debt security, has a callable, it's got a maturity date, the date on which the bonds expire, and the company has to repay the bondholders the face value of the bonds. There is no such provision for preferred stock. So they basically would last as long as the company exists if there is not a callable feature associated with that. So if you do have a callable feature, then companies could maybe at its option after a few years when they are doing really well and they feel there is really no need for them to have any preferred stock in their capital structure, at that point in time they could simply pay off the preferred stockholders and kind of get rid of this security. So let's move on and look at some of the different types of preferred stock that a company could be issuing. Preferred stock could be either a cumulative preferred stock or a non-cumulative preferred stock. This cumulation effect is with regard to dividends. For a non-cumulative preferred stock, they will only get dividends if the company declares and pays dividend in any given year. So if it is a non-cumulative preferred stock and the company does not declare dividends for 4 years, and this is the 5th year, and let's say they declare and pay dividends, then preferred stockholders, non-cumulative ones, will only get dividends for this year. Contrast that to the cumulative preferred stock. So let's take the same example. No dividends declared and paid for the last 4 years, and the company declares and pays dividends this year. So for a cumulative preferred stock, not only will they get dividends for this year, they will also get all the dividends in arrears going back those 4 years when they didn't receive any dividends. So that's a very attractive feature. On top of it, preferred stock sometimes could also be participating. Now this is called almost like double dipping. So a participating preferred stock, not only do they receive their dividends first before common stockholders get any money, then what they will do is after they receive their dividends with whatever money is left over, then they will share that remaining dividend with the common stockholders. So a preferred stock that is participating could either be partially participating or fully participating. If it's cumulative and fully participating, then that's actually a very good security to buy and hold. Then I've already talked about the convertible feature of preferred stocks and the callable feature. Sometimes they may even be redeemable, which means this company has already informed its preferred stockholders that it will call the preferred stock back at a specific date in the future. If that happens, and if there is a fixed date on which the company is going to recall all its preferred stock, then we don't call it a stock any longer, because now it's no different from debt, because it has a fixed maturity date. And this kind of a preferred stock is then listed on the balance sheet along with the other long-term debt. So the beautiful thing about preferred stock is that the accounting, the journal entries, so on and so forth, that we record for preferred stock, they are identical to everything that you learned for common stock. Same exact journal entries. So let's go ahead and look at some of the features of preferred stock in terms of recording preferred stock. Take this example. Bishop Company issues 10,000 shares of $10 par value preferred stock for $12 cash per share. So Bishop is going to record the issuance of the preferred stock as follows. They will debit cash for the money received, which is the 10,000 shares times the $12 cash received per share. That's $120,000. Now, what do you remember about recording common stock? Well, I have told you before that when you record common stock, you can only put the number of shares issued times the par value of the common stock in the line account common stock. Guess what? We use the same exact rules for preferred stock. So in this case, Bishop is going to credit preferred stock with the 10,000 shares issued times the $10 par value, which is $100,000. So any cash that they have received over and above the $100,000 will be recorded in additional paid in capital preferred stock. So much for preferred stock. Let's now move on to the dividend policies. Dividend policies followed by companies are very different, very varied, and there are several reasons why they have all kinds of different dividend policies. In fact, there is a whole area in finance dealing with why companies issue dividends like they do. Okay, so there's a lot of stuff going on there. Let's not worry about that for a minute. Some reasons why companies may maintain a specific dividend policy might be maybe to smooth income and smooth the dividends paid out, so keep it steady, because their earnings may not be smooth. It may be going up and down. But if a company says, well, I'm going to pay 5% dividend every year, what they are doing is they are deciding to smooth out the dividend payments. Other companies may decide not to pay any dividend at all. This is typical of companies that are brand new that want to grow. So they will not pay any dividends in the growth years. In those years, they will simply retain all the earnings and reinvest and grow. So you can read this section of the book yourself. There's nothing much that I can add here. So let's move on to the next slide. Here, this slide shows you that companies typically pay 4 different types of dividends: cash dividends, property dividends, liquidating dividends, and stock dividends. Understand this: for cash dividends, property dividends, and liquidating dividends, these are all dividends where stockholders' equity goes down. Okay? Now for stock dividends, that doesn't happen, because all we do is we move money from the retained earnings section up to the paid in capital section. So total stockholders' equity does not change. So let's now go and start discussing each of these dividends in great detail. Okay, so let's get on with the different types of dividends. We will start with cash dividends. Typically, for cash dividends, companies have 3 specific dates that they follow. The day on which the board of directors meets and through official board resolution declares a dividend, that date is called the date of declaration. As soon as the official board resolution has been passed declaring a dividend, immediately it becomes a liability of the company. Notice this: the board has to do this through official board resolution. If they don't resolve, if they don't pass a resolution and they're just talking about declaring dividends, that's no good. It's not a liability. But as soon as the dividend has been declared, it becomes a liability of the company. So the date of declaration is the day on which it's actually declared. So let's say the board of directors of our company meets today and declares dividends. So that's the date of declaration. Now here's the question. Who are we going to pay the dividends to? So then the board will say, all right, we declared dividends today, $100,000, but who do we pay it to? So we will probably then sit down and discuss and say, okay, let's pick February 15th. And we'll say, anybody who owns a share of stock in our company on February 15th, end of business, so at 5 p.m., February 15th, we will give those people dividends. So then that date becomes the date of record. We don't need any journal entries for that day because all we are simply doing is figuring out who owns shares of stock in our company. So then February 15th comes and goes. So the question then becomes, when are we actually going to pay them the money? So then again, the board will decide, let's say the 1st of March, that seems to be a good day. So we'll say on the 1st of March, we will give this $100,000 to everybody that owns a share of stock in our company on February 15th. So 3 dates, the date of declaration, which is today, the date of record, which is February 15th, and the date of the actual payment, which is March 1st. All right. So on March 1st, all we do is we basically pay the dividends off. 3 very important dates connected with dividends, cash dividends and property dividends, and even for that matter, stock dividends. So let's go ahead and see how this works with examples. So take this illustration. Roadway Freight Corporation on the 10th of June declares a cash dividend of 50 cents a share on 100,000 shares. Now this is payable on July 16th, that's the date of payment, to all the stockholders of record as of June 24th. So on this day, June 10th, Freight Company, this Roadways Freight Corporation, is going to record the simple fact that they now have a liability to pay this dividend. How do they do that? They debit retained earnings for $50,000. How do you calculate that? 100,000 shares outstanding. Remember this, we only pay dividends on the shares outstanding. So 100,000 shares outstanding, 50 cents per share is the dividend. 100,000 times 50 cents gives you $50,000. Where does this money come from? It comes out of our retained earnings account. Keep that in mind. Retained earnings, that's what we use to pay cash dividends. So that's the debit. What's the credit? Well, they haven't yet paid this, have they? No. So we have to now credit the fact that this is a debt, this is a liability of the company which will be paid in the future on July 16th. So we credit dividends payable. So this is the journal entry we will record on the day the dividends are declared. So how about the June 24th date? Date of record. No need for a journal entry, right? We're not paying any money, nothing. We're just making a list of all the names and addresses of the stockholders. Good. How about July 16th, the day that the company actually makes the dividend payment? Well, we need a journal entry. And it's a pretty simple journal entry. We debit the liability, dividends payable, and we credit cash. We are all done. So that's all you need to know about cash dividends. 3 dates, date of declaration, date of record, and date of payment. All right. So now let's move on and talk about another type of dividend. So in this slide, we are talking about property dividends. So sometimes a company may choose to give out a dividend, not necessarily in cash, but maybe some other property that they have that they want to liquidate and pay off to their stockholders. If that happens, then we need to remember 2 very important things that the company has to do. On the day that the company actually declares the dividend, on that very date, whatever is the property that the company wishes to pay as dividends will have to be marked up or marked down to its fair market value. So if the property that, let's say, my company wishes to give out as dividend cost me $50,000 10 years back, and I'm planning on giving it out as dividends now, and today, the date of declaration, that property is worth $1 million, then what I do is, as soon as I have declared the dividends, I will mark up my property to $1 million. And if there is a gain, which we have in this case, I will record that gain. Also remember this, the property may not necessarily go up in value, it may have lost value. If that's the case, then we mark it down and we take that loss. And then we are going to pay off that property at fair value to our stockholders on the date of payment. Let's look at a simple example that will illustrate this for you. So in this slide, we see that Trendler Inc. has transferred to stockholders some of its equity investments with an original cost of $125,000 by declaring a property dividend on December 28, 2011. Now this will be given out or distributed to the stockholders on January 30th. To all the people who own stock in the company on the 15th of January 2012. So the date of declaration clearly is December 28, 2011. The date of record is January 15th, 2012. And the date of actual payment is January 30th, 2012. So let's see how we are going to work on this. We are also told that the securities that we are going to give out as dividends now have a fair market value of $200,000. Remember, the original cost was $125,000, but today, on the date of declaration, the value is $200,000. So we really need two journal entries here, and let's take a look at those two. So the very first thing we do is we are going to mark up the property up to its $200,000 value. So to move it up from $125,000 to $200,000, I need to debit that security for $75,000, which I'm doing. I also need to recognize that there is an unrealized holding gain here of $75,000. So I credit that. And then of course I'm going to record the liability. So I debit retained earnings, $200,000, and then I credit common stock. Now here's the question. How much do I credit common stock for? So we are going to credit the property dividends payable. So two entries. First entry to bump up the property dividend, the equity, to its current fair market value. The second entry just to record the fact that now we have a liability. Then on the date of distribution, all we will do is we will debit the liability and credit cash. So in this slide, we see an example dealing with a property dividend. Trendler Inc. transfers to stockholders some equity investments costing $125,000. Now that's the original cost. So the date of declaration here is December 28, 2011. The date of record is January 15th, 2012. And the date of payment is January 30th, 2012. Okay, three specific dates. We are also told that the equity investments that originally cost $125,000 are worth $200,000 on the date of declaration. So let's go ahead and record the journal entries. We need two. The first journal entry will be to record the equity investments up at fair market value. So we'll have to bump it up. So the very first thing we do is we debit the equity investments by $75,000, and that will take care of bumping it up to the fair market value. Now because we have bumped it up, there is an unrealized holding gain which we realize by crediting that. And then the next entry would simply be to record this as a payable, a liability. So we debit retained earnings, that's where the money is coming from, and then we credit property dividends payable to show that now we have a liability. So this is all we do on the date of declaration. As always, on the date of record, we don't need a journal entry. All we need to do is make a list of all the names and addresses of the people who own a share of stock in our company, Trendler. So on the date of payment, what do? We will then now reverse the liability. So we debit property dividends payable, and then we simply credit equity investments to get it out of the books. Essentially what we really do is we take the equity investments, cash it out, and then pay the dividends to all these stockholders. Now let's move on to the third type of dividends that companies normally will distribute, declare and give out. This third type of dividend, we call these liquidating dividends. Now why do we call it liquidating? For a very simple reason. We do not pay these dividends out of retained earnings. These are not paid out of the earned capital of the company's stockholders' equity section. What do? We pay liquidating dividends out of the paid in capital. So we will actually dip into additional paid in capital common stock to pay this back. When we do that, we are liquidating the stockholders' paid in capital. That's why we call it a liquidating dividend. The next example is going to illustrate this to you in a very simple fashion. So let's take a look at that. So here you see that Chesney Mines has issued a dividend to its common stockholders worth $1.2 million. Now this dividend announcement notes that stockholders should consider $900,000 out of this $1.2 million as regular income, which means this is regular dividends, and then they should consider the remaining $300,000 as a return of capital, or in other words, as a liquidation of their paid in capital. So in this case, the journal entry that the company will record on the date of declaration is very simple. Take a look at it. We will debit retained earnings for $900,000, which is the regular dividends that they are paying. The remaining $300,000 that they are paying, which they have told the stockholders to consider a return of capital, is actually a liquidating dividend. And like I told you, liquidating dividends are paid out of additional paid in capital common stock. So we are going to then debit paid in capital in excess of par common stock for the $300,000. And then we simply credit dividends payable for $1.2 million. So make a note here. Regular dividends are paid out of retained earnings. Liquidating dividends are paid out of additional paid in capital common stock. So now what do you do on the date of payment? Debit dividends payable, credit cash. Very simple. That's it. So now we have talked about cash dividends, property dividends, and liquidating dividends. So we come to the fourth type of dividends that companies declare and pay. These are called stock dividends. Now remember, stock dividends do not decrease stockholders' equity. It's simply a rearrangement of money moving from retained earnings up over into the paid in capital section of the balance sheet, stockholders' equity section. So stock dividends are of two types. Either we can have a small stock dividend or a large stock dividend. So what is a small stock dividend? Well, anytime a company declares and pays a dividend that's 20 to 25% of its common shares outstanding, well, that's considered to be a small stock dividend. So what is the amount of the dividend that we need to record? Well, here's what we do. For a small stock dividend, the amount of the dividend is going to be the number of shares that the company will pay as dividends multiplied by the market price per share. Market price equating to the fair market value or the fair value per share. Keep that in mind. It's very important. For a small stock dividend, the amount of the dividend is the number of shares that the company is going to pay out as dividend times the fair value or the market price per share. So what do we do once we have computed this number? Well, that's what we take out of retained earnings and then shift into the paid in capital section of stockholders' equity. So let's take a look at this example. So in this illustration, you see that Wine Corporation has 1,000 shares of $100 par value per share outstanding, and it has retained earnings of $50,000. So now if Vine Corporation declares a 10% stock dividend, okay, 10% stock dividend, very simply speaking, is less than 20 to 25%. So this is a small stock dividend. So then it's going to issue 10% of 1,000 shares, which is 100 additional shares as stock dividend. So now the question is, what is the fair value per share? Because that's what we need to use, right, to figure out the amount of the dividend. The problem tells us that each of these shares has a fair value or market price of $130 per share. So now, on the date of declaration, this is what we do. We are going to debit retained earnings for 100 shares times $130 per share, which is $13,000. So what do you credit? Well, I just told you that we're going to take the money out of retained earnings and move it up to the paid-in capital section of the stockholders' equity in the balance sheet. So what do you have in the paid-in capital section? Common stock and additional paid-in capital, right? So let's do this. Let us now record how much goes into the line common stock and how much of this $13,000 is going to go to the account additional paid-in capital. So you need to know by now that the only amount we can take into the line account common stock is simply going to be the number of shares issued times the par value. So in this example, that's going to be 100 shares that will be paid out as dividends times the $100 per share par value. We don't give it to them yet because remember, today is simply the date of declaration. We have to actually wait until the date of payment to convert this into common stock. So what do we call it today? We call this common stock dividend distributable. All right, and the excess of $3,000 will simply be recorded as paid-in capital in excess of par common stock. So what do you do on the date of payment? Well, we are simply going to debit common stock dividend distributable and credit common stock. That's it. So here is an example dealing with a small stock dividend. So let us contrast this and look at an example dealing with a large stock dividend. So for a large stock dividend, anytime the company declares and pays a dividend greater than 20 to 25% of the shares outstanding, that is considered to be a large stock dividend. So what's so special about a large stock dividend? Well, for one, the amount of the dividend is calculated differently. How? The amount of a large stock dividend is simply going to be the number of shares to be paid out as dividend times the par value per share. Remember, for a small stock dividend, what value did we use? The fair market value per share. But for a large stock dividend, we don't do that. We simply take the number of shares to be issued times the par value per share and shift it out of retained earnings to the line common stock. That's all. There is no additional paid-in capital in this scenario. This example will demonstrate that to you. So in this case, Rockland Steel has declared a 30% stock dividend on November 20th, which will be paid to the stockholders on December 29th. And the date of record is December 12th. So on the date of declaration, 1 million shares of $10 par value are outstanding. And the fair market value per share is 25 bucks per share, which really we don't care because this is a large stock dividend, greater than 25%. So how many shares are now going to be paid out as dividend? 30% of a million, which is 300,000 shares. And then what is the amount that we are going to associate with these 300,000 shares? It's going to be the par value. So take 300,000 shares times the $10 per share par value, and you have the amount of the dividend, which is $3 million. What is the journal entry that we record on the date of declaration? We debit common stock dividend distributable. Actually, on the date of declaration, we debit retained earnings and we credit common stock dividend distributable, and then on the date of payment we debit common stock dividend distributable and credit common stock. So this very last slide in this series, in this particular video lecture, is talking about a stock split. So how is a stock split different from a large stock dividend? Simply speaking, nothing changes in the stockholders' equity section with regard to the amounts. The paid-in capital amount remains the same before a split and after a split. The retained earnings remains the same before the split and after the split. So what really happens? Well, if it is a split that is splitting the shares into greater number of shares, let's say for example they say 2 for 1, which means every share of common stock will now be split into 2. If that is what is happening, then all we will see on the balance sheet happening in the stockholders equity section is the number of shares will go up, the number of shares outstanding that is will go up, and the par value per share will come down. Take a look at this example that demonstrates this to you. So before the split, common stock, they had 1,000 shares of $100 par value, which is $100,000, and they had retained earnings of $50,000 for a total stockholders equity of $150,000. Then they do a 2-for-1 split. So after the 2-for-1 split, now we have 2,000 shares outstanding. However, the par value per share has now dropped from $100 per share to $50 per share. What is the common stock value in the outer column? It is still $100,000, no change. How about retained earnings? No change, still $50,000. How about total stockholders equity? No change, it's still at $150,000. So it's only the presentation that changes and the number of shares outstanding and the par value. So that pretty much concludes this session of our video lecture for today. Have fun.